Well, hello everyone. This is Aaron Filbeck, Director of Global Content Development here at CAIA Association. I'm joined today by my friend Tony Davidow, and today we're going to be talking about goals-based investing. And I guess before we get into the discussion, Tony, maybe you could just introduce yourself, give a little bit about your background, and talk about your book that's forthcoming.
Yeah, absolutely. I'm thrilled to be here, Aaron. You know, this is a topic that you and I have talked about quite a bit over the years. After having, senior management roles at firms like Morgan Stanley and Guggenheim and Schwab, a couple of years ago, I set up my own firm because I wanted to create my own content and really be unfiltered in the sort of things that I talk about and write about. Most recently, you and I have worked together on a project with iCapital and CAIA developing comprehensive alternative education for advisors. And I think much of what I've spent most of my career focused on is how do we help advisors and how do we help clients have better outcomes? And that was essentially the genesis for my book. The book is really designed to challenge advisors to continue the evolution from what was originally a stockbroker model to a financial consultant model to an investment consultant to a wealth manager. And again, we need to continue to evolve to stay abreast of all the changing financial landscape and all the new products coming to the marketplace.
Absolutely. And I think in addition to the work we did with iCapital, you've also been very instrumental in some of our updates to the 2022 CAIA Level 2 curriculum, where we've introduced some readings on private wealth management alongside family office. So I think really trying to go a little bit more beyond just the family office and into some of the stuff that you've really dealt with. Maybe we could just start there. You mentioned just briefly the evolution of the advisor. Could you just talk about that and what that has gone from in the past to where we currently sit?
Yeah, and I'd say, we've evolved quite a bit. I mean, it's been multiple iterations. If we go way back, the original value of a stockbroker was recommending I've got a high performing stock or mutual fund to more of a consultative sort of relationship with advisors, with clients. But I think at the end of the day, one of the things that has troubled me, and I know it's something you and I have talked about, is I think that as much as advisors have evolved, clients still sometimes think of the value of an advisor is outperforming the market. And that's a fool's game. That's a loser's game, because we all know that that's really not what the advisor should be solving for. And in much of my research around goals-based investing is trying to, one, help the advisor pivot, but also help the client understand what it is that we're trying to help them with.
Yeah, agreed. Absolutely. And so this video will be paired with a blog post that you wrote on CAIA's platform, just talking about kind of upgrading that toolkit for the advisor. And I think it was interesting, one of the things that you pointed out on this blog post was just capital market assumptions. And I think, when we look at the tangible output of what a 60-40, which is usually, the moderately aggressive portfolio that we've used historically, that return's pretty abysmal, and you kind of see that advisors are going to have to go outside of, going beyond just stocks and bonds. One of the things that I thought was interesting beyond just the capital market assumptions is there's that tangible element to portfolio management, but then there's also a philosophical thing that I know you and I have talked about, which is the starting point. And I think a lot of advisors and a lot of investors, clients as well, start with that allocation rather than starting with that objective that they're trying to accomplish. Maybe you could speak a little bit to that as well.
Yeah, so again, former institutional consultant, we all kind of adopted this 60-40 portfolio because it was convenient and easy to understand. And the expectation was I'd get my 10.2% long-term historical average of the equity markets. I'd get my 4% income from my bond portfolio. And I got some level of diversification because stocks and bonds, in theory, don't move in lockstep with one another, except the math doesn't work. Right. So if the capital market assumptions are true, and virtually all capital market assumptions that I've looked at project equity returns to be 4 to 5%. We know fixed income yields are at generationally low levels. We know that correlations are increasing. And we also know another dynamic that isn't factored into most mean variance models, and that is inflation. Now, all of a sudden, we really have a challenging sort of skill set, right? So we've got to figure out how are we solving for all of those things over time? How do we increase the return, increase the income, decrease the correlation across asset classes, and solve for this corrosive impact of inflation? And that's not something easy to do if we're driving in the rearview mirror with stale and unuseful data.
Yeah, absolutely agreed. And I think we've seen a lot of, especially in the wealth management space, a lot of demand for alternatives and moving into private markets, hedge funds, real assets, private credit, you name whatever the asset class is, there's a lot of demand for this stuff and a lot of product that's really been kind of pushed down from the asset managers. But one of the things you pointed out in your post, and something that we talk quite a lot about at CAIA, is just the massive dispersion between managers in some of these different asset classes. You might compare a large cap equity, publicly traded equity manager that's looking at Apple and Facebook and Amazon, and the dispersion between top quartile and bottom quartile might only be 2 or 3%. So you're not really going to get dinged too much from an absolute return standpoint if you pick a bad manager. You look over at venture capital or private equity buyouts or anything like that, some of that dispersion could be as wide as 20%. So exactly. I'm interested in some of the conversations you've had. How are you either working with clients or how are advisors kind of wrapping their heads around the importance of dispersion in manager selection?
Yeah, I think there's a huge premium. As you point out, you can afford to make a inferior investment decision when you're selecting a large cap manager because the difference between the top and the bottom is relatively small. If you look at private equity, again, it could be 1,800 to 2,000 basis points. So there's a real premium on it. So again, I think if we just take a step back a little bit and we start with, what are we trying to solve for? And if I'm looking at my private equity as the opportunity to get that enhanced return, and I think most people would look at it that way, I really want to make sure that I'm identifying, all the stuff that you guys do such a great job talking about it in the due diligence section, which is I need a top quartile manager, right? I need a manager who has historically done this over time, not somebody who's new to the dance. They have a long history of identifying great private equity opportunities. I want to make sure I've got them in the right structure. And in a lot of the education that you and I worked on together with our friends at iCapital, it was really going through some of those structural considerations. So as great as it is, we're now getting more products coming to the marketplace, you need to make sure you're getting access to the top tier manager. You want to make sure you're getting them in a structure that there isn't a huge haircut, right? Fees can be terribly corrosive there. So you really want to go through a very diligent due diligence checklist to identify the manager, the strategy, the structure. And then as you drill down, really looking under the hood, making sure that what you're getting is what you've kind of bought into. The other thing, of course, that I think is worth noting here is we should also think about private equity and private credit and real assets as long-term investments. So I wouldn't want people to think about it, I'm going to buy it today and sell it tomorrow. They should think about it as a long-term investment, a 10-year investment, a 12-year investment, whatever the duration is. So it really does change the mindset. And I think, you and I talk a lot about the fact that we want to learn the lessons that we've been taught by the big institutional players, whether it's the Harvard and Yale endowments. We also need to point out to individual investors and to advisors, there's a lot of differences. Most individual investors don't have perpetuity as a time horizon. They don't necessarily have access to all the great ideas that the Harvards and the Yales do. They don't have dedicated teams doing it. So there's a real premium in understanding what you're doing, how you're getting exposure, and making sure that the pieces of the puzzle fit together appropriately.
Yeah, absolutely agreed. Access is one of the most important elements of having good outcomes when it comes to investing in some of these different strategies. I want to go back to a comment that you made before about the evolution of the advisor and clients still viewing the value of the advisor as outperforming the market. And it really comes down to how we think about benchmarking. And benchmarking, maybe from an investment standpoint might be a little bit more straightforward, but how do you think about, benchmarking holistically from a financial planning standpoint, but also just how we think about investments and how we should be benchmarking success?
Yeah, and I often joke that we all know that investors really have three benchmarks, right? They want to outperform the S&P 500 when the market's going up. They could have done better sitting in cash when the markets go down. Or a lot of my friends, it's all about what did my friend do? What's my best friend's portfolio? And Aaron, I don't know about you, but most of my friends lie. And I mean that because they only focus on the ideas that work out. They never talk about the ideas that fail. They always talk about, hey, I was in this hedge fund that was up 30% last year. So the reality is, I think benchmarking is a real challenge. And to me, one of the beauties and the elegance of goals-based investing is what we should really do is, rather than set out to outperform the market, because I don't know if that's the right or the wrong goal. Generally, it's going to be the wrong goal. What I really want to do is I want to sit down with a family. I want to understand what they're solving for. And it's very likely they're solving for multiple things over multiple periods of time simultaneously. If they're solving for funding their children's education, that has a finite duration to it. If they're funding for their retirement, they can actually match out what it is they're trying to do over a 20 to 30 year time period, whatever their time horizon is. They may be thinking about gifting strategies from one generation to the next. So I really think it's instructive, rather than just falling into the trap of my goal is outperforming the market, or my value proposition is beating the market. It's what specifically am I solving for each pool of money, and setting out what is the benchmark of getting there. And again, the time horizon to get there may be long, short, and then consistently monitoring the progress relative to those goals. I think the temptation is always, when the market's up, is we do all this great planning work in the beginning, but when the market's up, we're saying, hey, we outperformed the S&P 500 this year. And then when your performance is lagging, you kind of switch back into it. We need to be consistent. We're measuring progress relative to a goal. It doesn't mean that goal isn't going to change over time, because the circumstances of the client will change, but at least it keeps us on a more predictable sort of course. And it allows us to make those subtle adjustments to correct course, as opposed to, setting ourselves up to fail if we're trying to outperform the market over all time periods.
Yeah, absolutely. And I think it's interesting to look at, the way that some of the large institutions have done this so far. I mean, the endowments and the pensions, they have absolute return targets. It's not necessarily you need to outperform the market. It's, can we fund the operational funding for this university, or can we make sure that our participants in the retirement plan can clip that income on a monthly basis? And I think trying to pivot the individual towards that type of mindset could be pretty powerful, especially in an environment like this, where, especially in the traditional markets, forward-looking returns are, much to be desired there.
Yeah. And it's going to be much more challenging, I think, in the next 10 years than the last 10 years. Again, the last 10 years, I'm sure there are a lot of people listening to this podcast and saying, well, I did just fine with the 60-40 portfolio from 2009 to 2019. Well, of course, in a bull market, when, the returns are constantly going up and it's just a question of magnitude, that's fine. But when you're dealing with a choppy environment, you need to solve for, how am I going to get the incremental return? How am I going to get the income that I expect out of my portfolio? How am I going to dampen the volatility? Because we know there will be shocks along the way. And then now I've got to add the additional ingredient of how am I going to hedge the impact of inflation? So again, as we started the discussion, I think advisors need an expanded toolbox, and that includes alternative investments. That includes hedge funds broadly and private markets broadly. And then we get into what each one of those underlying strategies solves for. But I think we need to think about, how do the pieces of the puzzle fit together? And do you need to make adjustments over time as the market conditions change?
Yeah, this might be a little bit of an interesting question, something that I've thought a lot about. How do you feel about, especially for some of the clients that have multiple objectives associated with, what they're trying to accomplish? Maybe it is a bulk of it saving for retirement, but they have charitable aspirations, or maybe they're funding some kind of supplemental income. How do you feel about the concept of mental accounting? I think that's been frowned upon in some of the traditional financial circles, but from a behavioral standpoint, it seems like it would actually work pretty well.
Yeah, I think, again, I think what I tend to look at is, I look at each pool of money, and each one of those should have a goal and a time horizon and the underlying investments to get there. I think mental accounting, oftentimes we think of it in a negative sort of way, right? Because investors have these biases that are kind of built in. But I think if we take the emotional aspect out of it and we just try to solve for, what am I trying to do with each pool of money? That actually makes a lot of sense in my view, because your personal assets, you may be willing to take on more risk than your retirement assets, which may be more geared towards generating income. Or if you're dealing with a large family and they're thinking about trust from one generation to the next, they may be willing to take on more risk, because the lifetime of this portfolio is 20, 30, 40 years down the road. So again, to me, I think that's the way that we should be thinking about it. What are the pools of money? What are they solving for? What's the time horizon? And then ultimately, what's the right combination of asset classes that gives me the highest probability of achieving those goals over time?
Yeah, absolutely. Maybe we can finish off with just one question on, or a couple of questions on communication, because I think especially, to your point again about clients' expectations, the advisor value proposition being outperforming the market, and really trying to pivot that over to more of the objective goals-based orientation. How do you think about it? What advice do you have for advisors who are trying to think through better ways of communicating, one, their value proposition, but also how the underlying investments do relate to those goals and objectives?
Yeah, and Aaron, it's something I do spend a fair amount of time talking about in my book, because I think for some advisors, it is a pivot from the way that they've developed their relationships. I think ideally, if you're starting with a fresh relationship, you want to begin with that goals-based discussion in the very, very beginning. You want to sit down with them and say, we're going to look at each one of your discrete pools of money. We're going to establish realistic goals of what we're going to accomplish over what time horizon and what the journey is going to be to get there. I think the challenging thing is the pivot. If you haven't set up that relationship, how do you change the dialogue with the client to get them on the right course? And again, I never think it's too late to revisit a client relationship and say, I think we need to change the way that we've been working, and we need to change the trajectory of our relationship. But I think it's really important to start that goals-based discussion at the discovery phase. In the very beginning, establishing what are we doing for each pool of money, and then consistently on every engagement with them, whether it's quarterly or if it's year end, how am I doing relative to the goals? Do we need to make adjustments along the course of the way? And there's nothing wrong with making subtle adjustments. What's really bad is a complete departure from the strategy that you start with. But if you're making subtle adjustments because the market conditions have changed or the financial circumstances of the family has changed, I think clients appreciate that. They actually understand that you're not providing a cookie cutter solution. I think the really important thing is that we're listening to our clients and we're really understanding how they feel. And I'll just add one other thing, and that is that we've clearly come out of an environment where the emotions of clients have been stretched with COVID. And people started to feel very, very differently about their money when they didn't know the certainty of the market and whether they would have enough money to retire on. So again, I think we sometimes spend so much time focused on the portfolio and returns rather than really engaging them to understand, how do you feel about the markets? Are we taking on too much risk? Are we taking the right amount of risk? Do you feel you're getting the right level of communication where you understand what our strategy is and how we're progressing relative to that strategy? So communication, I think, is paramount when you go through periods of stress, and we've just gone through that. I'm not sure we're completely out of the woods on it. It wouldn't surprise me to have additional shocks along the way. So we should take those lessons learned during COVID and incorporate them in the way we engage clients going forward. Completely agree.
Well, Tony, thanks so much for joining me. Goals-based investing book should be out hopefully in the next couple of weeks. Is it November?
First week in November, it should be in the bookstores.
Perfect. Well, we'll be looking forward to reading that. And thanks again so much for the conversation.
Thanks for having me, Aaron. I appreciate it.
Thanks.